Well, good morning and welcome to Colliers George Street office. For those of you that don't know us, Colliers International is probably the third largest property company by turnover in the world, with wide coverage throughout the world and also through all the service lines. Okay, so that was the advert. I want to spend a little bit of time talking about the economy because I think it really figures in importantly in terms of where the occupier markets are going, which after all is sort of the bottom of the food chain in terms of property investment and all the rest. I think that the latest news that we've seen is that the Eurozone figures, I think, have disappointed slightly. I think the growth has fallen from Q2 13 from 0.3% quarter on quarter to 0.1% quarter on quarter in the Eurozone. The fortunes are a bit mixed. Italy remains in recession for the 9th straight quarter. I see that Berlusconi is reforming his old party and planning to stage a comeback. And I saw that there's some pretty horrendous floods in Italy at the moment, so I'm not quite sure if confidence is building in Italy just yet. France has also tipped back into a marginal economic contraction. Political uncertainty seems to be buffeting business investment, capital investment. I think, too, that in the process of the political wranglings, Paris has lost a little bit of its luster. I think there's, quite frankly, stepping back, I think France has a lot of long-term reforms that really need to be addressed, and I think it's making a lot of people nervous whether those long-term reforms are long overdue. Spain, in the meantime, has made quite a lot of progress in fixing and reforming its economy, and it's gradually paying off. It's shown expansion at about 0.1% quarter on quarter. Germany up 0.3% quarter on quarter, a little bit of a disappointment. There's good news and bad news. The bad news is that exports are a bit of a drag on the economy, and I think that probably has a lot to do with just general trading weakness worldwide. But the good news is that domestic demand in Germany is up, and business investment in particular has picked up, a theme I'll come back to in a second. The UK, in the meantime, is moving from strength to strength, although some analysts would say that, well, we've had the wrong kind of recovery. And what they mean, of course, is that it's a recovery stoked by household spending, stoked in turn by perhaps the housing market, stoked in part by government policy. Well, they're probably right, but at this point, after all these 5 or 6 years of malaise, I don't think we should look a gift horse in the mouth too much. But I'd say in another couple of quarters, I would really hope to see that business investment, expansionary investment, is back in the cards, because after all, it's this expansionary business investment that drives occupier markets, not just in the UK, but in the EU, and I think that's still the missing ingredient in the recovery. I've got Ireland down here. I could spend 20 minutes on Ireland. I think they've got a strong story to tell, but it's a bit of a complicated story also. So let's look at a few property bits of data, just to give a top view of where we are. These are property investment volumes broken down by Western Europe, UK, Central and Eastern Europe, 12-month rolling total. Not too exciting. It's gradually recovering, you could say, but we're still well down on where we were back at the beginning of 2008, I think is where this chart begins. So Western Europe's down still 50% in terms of volumes, UK down around 35%, and the CEE staging a comeback to only down 13%. Of course, it's coming off a low base, and I think the Central and Eastern Europe also, just because of the huge developments that are occurring in terms of transforming the economies, is likely going to tick up well above where it was in the past. Okay, so what do we have? We have some sort of recovery, which seems to be kind of in line with performance of the general economies. Up, but not too exciting just yet. If we look at pricing, and this is top-level rates, I think, too, that capitalization rates or investment yields are pretty much broadly consistent, too, with economic expectations. You can see that in the UK, it's been fairly fully priced for some time. We've got a little bit, I think just the sheer weight of money looking for a home is probably keeping yields at a lower rate. Although, having said that, the economy is now showing signs of traction, and I think the latest data, certainly from the IPD, but also from our agents in the field, suggests that I think some of the occupier markets may be beginning to turn. Let's not get too excited about retail just yet, but industrial has posted some positive rental growth for about 4 months in a row on the monthly index, which hasn't happened in an awful long time. I think there's, let's see, in Western Europe, things are, I think, also pretty much in line with weak performance of the occupier markets. If you broke this down, I think you'd find that that prime is a bit steady and the secondary seems to be shifting a bit more. Then we got the CEE, of course, where I think the weight of money looking for investments has certainly brought the prime part of the market down. One thing I want to underscore, and I think that the sorts of recovery that we're having it's a bit of a mixed picture, as you're going to see. I'm going to take you through a survey here in a moment. But the impact of the ECB's announcement some time ago that they would backstop the euro has really changed the game, I think, pretty much in Europe, in the UK, and certainly the perception of Europe from outside. Although the survey I'm about to show you is that it's perhaps less salient within Europe itself. Okay, so every year we've been doing this Colliers Global Investment Sentiment Report. This year we interviewed about 500 people, or I should say there were 500 or so respondents worldwide. We had a very good sample from across all the major regions. I'd say if you wanted to break it down into who responded, I'd say 30% would be institutional funds, 35% would be property companies, another 25% would be private equity and private investors, and the rest are other, so probably a smattering of all those groups together. So I think actually it's quite a robust sample, and we've come up with some really interesting results, which I think are probably consistent with a lot of experience that people here are having in the room. It probably lays the groundwork, too, for a lot of questions for the panel. The most striking result at the global level, given all the political uncertainty and economic uncertainty, certainly, too, over the past year, is that if you look at all the factors that influence global investors, according to these investors, that sovereign and political risk is well down the curve, that's in red, as being a key factor. So that's 1, 2, 3, 4, 5. It's the sixth most important factor. Now, as a property researcher, I could tell you that it warms my heart that property fundamentals are on the top of the list, because I spent an awful lot of time putting together these so-called fundamentals and publishing them in one form or the other, or advising people within the company also. But equally, I should tell you that there's quite considerable variance in these factors among regions. And I guess there's some humor in this, but sovereign and political risk is 8th on the list in America, about the lowest in the whole sample. Odd, because this survey was done pretty much during the time of the debt ceiling debates, when I think uncertainty was quite maximized. On the other hand, at the top of the scale, it was the Asians that was most worried about political risk. Of course, they're the guys that have the American debt. But of course, we're talking about property here too, and I would also say that the EMEA, and listen, by the way, when I say EMEA today, I mean EMEA in the survey excludes the UK. We broke it out because there was such a strong difference between the two, and I think that this juxtaposition is quite interesting. So we're talking about property here today, and let's see how this starts to play out. So if we look at this next chart, this is the same chart, factors in influencing investment, and you can see that property fundamentals are on the top of the list for both the EMEA, which is in dark blue, and the UK. But then if you go down to the sovereign and political risk, you can see that for the EMEA it's 3rd, whereas for the UK it's 7th. Again, I made the comment about the ECB's comments of supporting the euro. It seems to have been taken home elsewhere, but not necessarily in Europe. I think, too, that the argument about business investment struggling to gain traction in Europe, and hence stabilization of the occupier markets, is also linked to this uncertainty. And within the Eurozone itself, I think a lot of this political uncertainty has to do with the new regulations that are being implemented, particularly things like debt liability mutualization and other ECB policies. They're in sort of strange regulatory territory, which I'll come back to at the end, as to whether it's actually provided for within the treaty or whether treaty revisions are needed and all the rest. So there's quite a lot of uncertainty, I would argue. Nevertheless, if you look at investors both in the UK and in the EMEA, despite these worries, most people want to grow their exposure to property, grow their portfolios. In the EMEA, 61% want to expand or increase this year. In the UK, 73% want to expand. In the EMEA, 28% want to tweak their portfolios or rationalize, and 20% in the UK. So it's certainly expansive response. If we look at risk appetite, you start to see a difference here. In the EMEA, nobody really wants to take too much risk. About 33% say they're willing to increase risk, and part of that story might be that they may well think they've got enough risk already, and there's probably a good few people in the room here that might have a view on that. In the UK, far less risk averse. 74% people say they want to take on additional risk. Does this have to do with political or economic situation? Maybe, but I also think too that the sample is based on people who are based in these particular areas, and I think that the source of capital in the UK is a little bit more varied than in the EMEA from what I can tell, and may have a slightly different risk profile. So risk return, I have a hard time interpreting this chart, to be honest with you. What it tells you is that most people are expecting returns over the next 12 months of between 5 to 10%. A bit more in the UK, we expect this, and a bit less in the EMEA. And there's ever so slightly higher returns expected in the EMEA going forward. I suspect this has to do with the fact that in the UK, some markets have been fully priced for some considerable period of time. And in fact, I think secondary yields in the UK have also come in, and the gap between prime and secondary has already narrowed a bit, much more than has happened in Europe, and perhaps there's a bit more scope in Europe for this sort of convergence to occur, and a bit more yield compression to occur in Europe. So hence, perhaps there is the possibility of a greater return, certainly over the next couple of years in Europe. If you look at what people want to invest in, now don't forget, people are saying they want to take risk and they want to expand their portfolios, but one of the things that we've seen worldwide is that nobody's too keen to go cross-border. They'd rather stay in their own countries if they can find the assets there. And certainly in the UK, 61% of UK-based investors say, oh yes, we'll have some of London. That's not a particularly new story. What is perhaps new is Madrid is second on the list. You can see it falls quite substantially from 61% down to 4%, so it's quite variegated after that. But nevertheless, I think actually there's a bit of a story in Spain, and I think there's some people that are coming to the view that the economy has turned a little bit. There's a little bit more stability, and now it may be a buy opportunity. Still early days, and it'll only be for the brave, I suppose, but nevertheless, there is an opportunity there. If you look over the EMEA, you can see that there's no one primate city that seems to be driving it. The logical candidate for that would be London or Paris. London's still at the top of the list, but just so at about 10%. In Paris, I think it's slipped a bit. It's down around 6%. And of course, the German cities, which I think outside of Germany, forgive me, I think a lot of us tend to see as one sort of market, as it were, are also very popular. Risk appetite by asset class, this one's interesting too. I think that the profile here of what people want to invest in, both in the EMEA and the UK, is pretty similar, with a couple of exceptions, as you can see. But everybody wants offices at the moment. I think part of the story is that offices are fairly easy to understand. It's linked primarily to the credit risk of the tenant. The markets seem to be stabilizing, certainly in the UK, but even in the Eurozone, the period of, well, there was a time, if you remember, when we were expecting sort of another Lehman's-type crash somewhere, and where there was absolute fear was salient in the market. I think that's past now, and so I think people are seeing some good opportunities just in standard offices. If you run down, you can see that the UK looks like they'd like to take a bit more exposure in shopping centers, and I think a lot of people probably know the story. There are quite a lot of secondary shopping centers that are in dire need of capital expenditure and renovation, which probably offer pretty good opportunities in certain catchments. Then if you slide along to industrial and logistics, anybody that's working in the UK will know that there's a huge shortage of distribution space, quality grade A distribution space, so much so that the spec market seems to be just ticking over or just beginning again. Prologis have announced something, IM Properties have announced something just in the last couple of weeks, which would suggest that there's more traction there. And I think some figures we did internally was that in the southeast and London, grade A supply of quality distribution space has fallen to less than a 1-year supply. I think West London's a 3-month supply. And then, of course, if you go further up the curve, there's opportunistic, which I suspect has something to do with private equity chasing debt portfolios and other things that might be coming out of the banks that are still in various states of distress. The other thing that's coming clear is the debt story. Everybody says they'll use debt if they can get debt. Well, most people. In the EMEA, about 60% say that they intend to use debt if they can get it over the next 12 months. And in the UK, 65% say that they would use debt. Now, personally, and I was having a conversation with Peter Dempsey a minute ago, and saying that I'm a bit of a cynical guy, and I keep waiting for the first evidence that credit standards in the banks are starting to slip. And we decided that, well, no, it hasn't quite happened just yet. The LTVs have drifted up, certainly, and the banks do seem a bit more keen on lending. But we haven't seen any of the excesses, or I certainly haven't seen any of the excesses of the past, and I don't think that they'll be repeated in a hurry. Nevertheless, if we look at the results of the survey, and everything on the far side is what happened over the last 6 months, and for the UK is the far left-hand side. The light blue means that credit standards, 55% say that credit standards have loosened, whereas in the EMEA, everybody thinks that it's pretty much stayed the same, which means that it's still fairly tight. And going forward over the next 12 months, it's quite an interesting story. In the UK, considerable loosening, no change or loosening, is expected by the majority of respondents, with only a very few think that the standards are likely to tighten, whereas in the EMEA, most people think that it will stay the same or tighten quite considerably. And I think this all has to do with the perception of risk and, again, the uncertainty that exists in the Eurozone. I think this is actually quite a profound result. I think there's also uncertainty about the enforcement and timing of international agreements such as the Basel III and other sorts of national prudential regulation that's acting to slow the bank deleveraging that's going on. And I think actually there's a residual concern that the extent of some of the problems with some of the banks still hasn't completely come out, despite us being several years down the road now. Look, I want to end with just a comment about some things I see that are happening in the EU as a whole, in the UK. I mean, I look at the political risk argument in the UK, and political risk is not particularly on the agenda. It was number 7 or number 6 or something of this sort. Yet, we've got the Scottish referendum coming up that could fundamentally change the economy of the UK, theoretically. We have also the UK saying they want to renegotiate the EU relationship going forward. So there's prospect of an EU referendum by, say, around 2016, 2017. For me, as an outsider in a way, looking in, I find this, extraordinary bits of political uncertainty, and I can't help but think that this isn't holding back some of the recovery to a certain extent. I will say, though, there's been a couple of interesting things that have happened. This is what I wanted to point out to you, is that certainly our Chancellor has been doing his best to defend the London or the UK financial services sector, and there's questions about whether the financial transaction tax or whether the banker bonuses caps or whether the emergency short selling ban and other matters actually go beyond what can be enforced by treaty. And Osborne has pushed the question to the point where the EU Commission has received legal advice that, well, yes, maybe they do infringe treaties. They certainly discriminate against non-participants, and there's an extraterritorial aspect to it, which makes things a little bit more problematic. Then the bankers' bonuses I thought was very interesting. Apparently, capping bankers' bonuses could well be a violation of European human rights legislation, i.e. through employment law, which I thought was quite a novel approach to it also. But I think what the point I want to make out of all this is that I think there's also support for Osborne's positions of renegotiating so-called treaty overreach. I think of the Germans and the debt mutualization issues, and that doesn't have great political support in Germany at the moment, and I think there's a lot of other people that Osborne would find allies in for a variety of reasons. Hence, I think that if the Tories were to win the next election and that Cameron would have the chance to start renegotiating a policy, he may well find the territory quite ripe and may have some success in coming up with something that would perhaps even prevent the need for having a referendum going forward. In my own simplistic mind, I revisited a lot of the treaties that have happened over the last several years, last 20, 30 years, and I can't help but think that what we've done is we've come right back to the Maastricht Treaty in 1992, the year that we opted out of the social chapter. The UK opted out of the social chapter and also crashed out of the ERM. Here we are in 2013, Labour having opted into to the social chapter, and it just looks to me like the Tories are right back to where they were, and are just seeking a way to sort of opt back out of those bits of the treaty that they don't like. For me, looking into, I think that the UK has always seen the EU as primarily an economic vehicle and less of a political mission, whereas I think the Europeans would see it more of a political mission, and I think this difference hasn't gone away. Certainly, I'd say that there's scope for a lot of political uncertainty going forward over the next several years, and maybe the survey is right, that global survey that sort of pushes political risk down the agenda. Maybe the successful investors are going to be those that manage to look beyond the political risks, say for more of a 5-6 year time span, to find the returns based on economic fundamentals.